So as far as I'm concerned, I don't believe that there is the perfect company out there available for you to invest in the stock market today. So let's not forget, whenever we are backing our capital behind a particular ticker symbol, we are essentially placing our bets or essentially making an educated guess. I'm hoping that the company that we invest in is able to deliver more profits the next year compared to this year. And the company has a shrewd or honest management team that will be able to return the capital back to us as shareholders. So likewise, let's not forget that in the business environment, everything is dynamic. Your competitors are not just sitting there waiting to be stepped on, and every single factor out there, whether it's governmental, social, business, everything is changing by the day. So us as investors, particularly stock pickers, have to be on our feet, understanding the differences, understanding the nuances that are evolving day by day. So there is no good company forever. There is also no bad company forever. Those bad ones will probably go bankrupt sooner or later, which is also why, if you really study the history of the stock market, your greatest of the greatest companies that were trading back in the 50s, 60s, most of them has probably became dinosaur companies, and then you have your new wave of your FANG stocks that come into play. And let's also hope that the FANG stocks can continue delivering, but probably by the end of the century, it will not be the FANG stocks up there in the rankings anymore. So just be prepared that no good business will last being good forever. Forever doesn't work in the business environment. So there's just some preface and some context. So for myself, at least for those of you who clicked into this video, most of you probably know that I'm a huge ass Alibaba bull. Currently, I think around 50% of my portfolio is allocated to the stock. And yeah, let's not talk about how it has been performing. It has been a very big roller coaster ride. And I do believe that to a certain degree, the narrative or at least the story around the stock do follow or do emulate after the stock price. So Alibaba's stock price have been taken a beating for at least the last 2 years now, which is why there are more and more bearish views and bearish stance around the company. So I have kind of been one of those few in the YouTube platform trying to defend about Alibaba's performances, giving the benefit of the doubt, probably providing some color and some opinion around what the management team is thinking. But of course, these are all subjected to how capable on the execution and how they're going to deliver profits and margins in the coming near future, especially when many of these overhangs are slowly lifting from the Chinese economy. That said, I think many of you might be under the impression that, many of these people that are pumping particular companies like Baba, Tesla, Palantir, all of you are blind bulls. You guys are not aware of the issues around the company. And I think that's further away from the truth. I think there is definitely some fundamental issues with Baba as an investment. But also I just wanted to point out something that is a kind of a investment myth. Thinking that, you can only buy good companies or the best companies out there, and just hope that the best companies will continue performing at the best conditions. But sometimes, more often than not, many of these air quotes best companies have very lofty valuations and many expectations or optimism being priced into the stock. On the flip side, many of these beaten down companies, they just need to go from shit to become less shit, and that's how you extract value. And one of those very common example that just happened recently is around Meta platforms. Specifically for Meta platforms, many people are saying that, this is the end for Meta. Mark Zuckerberg has lost his way, burning so much cash into the metaverse. And you see, they essentially tripled in a short span of a few months. But that's besides the point. I think I'm just saying that there are many roads that lead to Rome, and these are just different investment philosophy. But for myself, I do like to look into companies that are beaten down, specifically unfairly beaten down. But that said, it's always a trade-off. So in this video specifically, I'm just going to be briefly discussing 3 key concerns or issues that I see as a long-time Baba investor. And of course, I'm not going to be talking about geopolitics or the Chinese government, etc., or the VIE structure, because those are essentially out of the control of the management team. So today, we will just specifically focus on business fundamentals. And these 3 main concerns are revenue quality, revenue growth, and also cash management. So let's first look into revenue quality. So in terms of revenue quality wise, if you do really dig deeper in terms of how the revenue is growing, Baba did post a 2% year on year based on the latest March quarter. And if you look at the year ended to have a more comprehensive view of how they've performed over the last 12 months, Even though total revenue grew by 2% year on year, if you to look at the breakdown of the quality, or in this case, looking at the quality of the revenue, China commerce, which is the main business, the bulk of the business, making up 67%, it actually shrank by 1% year on year, while the results by and large is being prompted up by the rest of the other business verticals, like international commerce, local consumer services, Cainiao, etc. So two of the most important business engines of Baba's business today, in my humble opinion, is actually the China commerce and the cloud business. And these two business is the lowest growing business, if you can see, if I were to just strip away the digital media and the innovation initiative arm. So this is definitely a call for concern, because if you invest into Alibaba, e-commerce is the biggest pie, while cloud will hopefully be the next driver engine, especially when it gets more and more saturated. So in terms of China commerce specifically, it has the largest margin of the entire business. Sure, local consumer services, Cainiao, international commerce, those are all promising business verticals as well. But firstly, the margins are much lower. And secondly, in terms of the foothold and in terms of the expertise and capabilities of Alibaba, it's definitely not as entrenched compared to commerce, or at least China commerce. So if you look at this trend or look at this evolution of Alibaba as a business, it's pretty similar to what Google is experiencing over the last 1 year or so. So you look at the top line, Google, despite being in a cyclical business, we might be in a recession and advertising is slowing down, they actually still grew top line by 3% year on year in 2023. And on top of that, this is from a high comps or high base effect, because 2021 and 2022, they had a spectacular run. And compared to Facebook or compared to Meta platforms, they actually experienced a negative year-on-year comparison. So on a superficial level, you might think that, hey, Google is probably a pretty high quality company, right? But then actually they are experiencing the same issue as Baba. So if you look at it, Google's current business, there are two main segments. Firstly, it's the advertising business. The second one is the cloud business. So if to really dive deeper into the advertising business, so YouTube ads compared on a year-on-year basis is actually down. It's down around $200 million. Google Network is also down. It's down by around $600 million, while Google advertising is barely holding on, even though it's still a negative year-on-year growth rate. And it's really the Google Cloud segment that's prompting up the whole revenue driver or revenue growth rate from 5.8 to 7.4 billion. But that's it. If I'm not wrong, as far as I'm concerned, the Google Cloud business itself is still not profitable, or at least they are barely break even, while the advertising business itself, it's highly profitable, the margins are great, but it's slowing down and it's having a negative year-on-year growth rate. So similarly, you can see that Baba and Google is experiencing the same sort of declining in terms of revenue quality. But that said, I think the saving grace, or at least to kind of sum up the entire discussion here, is number one, both main businesses, Alibaba's main e-commerce business and Google's advertising business, they have already reached a certain saturation point. You can't expect them to just grow indefinitely. There is a kind of a cap to their TAM, which is their total addressable market. But at least now, they are essentially pivoting their strategy to focus more of their efforts into the rest of the other business verticals to continue growing them. So yes, margins are going to take a hit. And even for Baba's case, you can see that margins are definitely taking a hit. Look at gross profit in terms of percentage of the revenue. At its highs, it was around 60 to 70%, and now it's hovering at 36%. While the operating income, similar story, 30 to 40%, now it's hovering over a little bit over 11 to 12%. So at least for now, from my understanding as a shareholder, I do believe that in order for you to grow, you have to expense out. That there is a lot of expenditures that is being associated to this sort of growth rates. So I do believe that Alibaba's operating income is much closer to 15%. For now, they're taking a short-term impact and a short-term hit. But after they manage to optimize their cost structure, ability to continue growing, then we can see some sort of normalization in terms of the margins wise. And yes, so this is just one of the key concerns. Of course, I do believe that it's a short-term impact in terms of their China commerce business, the impact in terms of the customer management revenue. Once things start normalizing and people start consuming again, I do believe that there is still room to play catch-up in terms of the margins. So that's the first one in terms of revenue quality. Secondly, let's talk about the revenue growth rates. So I mean, in terms of revenue growth rates wise, the three main e-commerce competitor out there in China today is Alibaba, JD, and Pinduoduo. So without discussing too much or without talking too much, if you to look at it in terms of the year-on-year growth rates, Alibaba's revenue growth rates has been taking a beating. On a trailing 12 months basis, it's up around 1 to 2%. While if we were to compare to JD.com, JD.com actually similarly is experiencing this sort of issues or challenges in the short term. So their growth rates, their revenue growth rate is also in the north of like 1%, point something percent. Pinduoduo, on the other hand, is actually the one punching above its weight. Revenue growth rates are still in the 10, 20, 30%. And even in the latest quarter, I think they kind of beat expectations. So what is exactly happening? Firstly, let's not forget the fact that just for contextual understanding, Baba is the biggest out of the three, and arguably Baba's commerce business is 2 times bigger than Amazon in terms of GMV comparison. So revenue-wise, yes, they lose to Amazon because of the way they recognize their revenue. But Alibaba has already reached a certain saturation point, just for commerce specifically. So you want them to continue growing like Pinduoduo's kind of growth rates at like 100, 60, 28%. It's probably a far cry, and they're unable to do it. So that's the first one. The second one is really the idea of how China has been experiencing the recessionary pressures over the last 2 years. So China has recently came out of COVID. Many people, or at least consumers' confidence, hasn't been at a tip-top condition. So people naturally, in a very bad environment, or people that are not optimistic of the future, they would naturally gravitate towards buying cheap products and not willing to spend, trying to cut back on spending and tightening their purse strings, which is why Pinduoduo has been kind of punching above its weight, because Pinduoduo is they have a laser focus in terms of delivering dirt cheap products. So you can see that it's the same sentiments. JD, very lousy growth. Alibaba, very lousy growth. And all the growth rates are being sucked up to Pinduoduo. I do believe that this is a short-term transitory issue when things start normalizing. As we all know, economic cycles go in terms of peak to trough. So likewise, in this entire slowdown recessionary environment, I do believe that the Chinese consumers are getting a little bit jittery, and they've been very conservative in terms of their spending. I don't foresee this to continue perpetually, so that's why I do think that this is a short-term issue. Do feel free to leave in the comment section down below what you think of this. But this is basically the story behind why I'm still invested in Baba. I think that these two are both short-term issues. So the last part is really the idea of cash management. So if you were to look at Alibaba's cash management, I think it's to nobody's surprise that they currently hold a huge ton of cash on their balance sheet. Their net cash position, this is netted off by the way, net cash position $58 billion. And Baba is trading in the markets of around 200 to 220 billion. So yes, 1/4 of the market valuation is in cash today. So yes, this provides a huge margin of safety for potential Baba investors, but at the same time, it really begs the question, are they allocating this resource, or are they allocating this capital efficiently? Do they really need 1/4 of their market cap on the balance sheet? Are there even better projects out there that can yield a better return on capital compared to the internal rate of return that they require? Or is it better off return to shareholders? And yes, I do acknowledge that the management team have been stepping up the buyback programs. They want to keep buying back shares at an undervalued level. But many investors have been lamenting on the side that they could have bought back faster. At this dirt cheap valuation, there is a lot of room to go, and they have been very slow in deploying this capital. So it's really this confidence factor that investors are kind of casting aspersions. Do they really know what to do with the capital that they have on their balance sheet today? So these are just my 3 main concerns. Do feel free to leave in the comment section down below. Do you agree or disagree? And I hope that I'm not like a blind Alibaba bull, or at least I hope that I'm rational when going through this earnings report. And yes, I do place certain emphasis in terms of monitoring the margins, monitoring the growth rates, and just the individual breakdowns and emphasis on the management team itself. So with that, I'll see you in the next video, but more importantly, I will finally see you on the moon. Goodbye!